Imagine you're worth $10 billion. You own private jets, luxury homes, super yachts, and companies worth billions of dollars. But here's the strange part. You don't necessarily earn billions of dollars as a salary. So how do billionaires become incredibly wealthy while sometimes reporting surprisingly little taxable income? The answer isn't a secret loophole. It's understanding how the tax system actually works. Today, we're looking at 7 legal strategies wealthy people use to reduce, delay, or manage their taxes. And number 1 completely changes the way you think about being rich. Number 7. They don't rely on a salary. Most people earn money by working. You receive a paycheck, taxes are withheld, and you spend what's left. But many billionaires don't build their wealth primarily through a salary. Their wealth may come from owning stocks, businesses, real estate, and other assets. And here's the key difference. Owning an asset that becomes more valuable isn't automatically the same as receiving taxable income every year. For example, imagine someone buys shares for $10 million, and years later those shares are worth $100 million. They have gained $90 million in value. But if they haven't sold the shares, that gain generally hasn't become a realized capital gain yet. That's one reason the tax picture for wealthy investors can look very different from that of someone earning a salary. Number 6. They prefer assets that can grow. Now let's take that idea one step further. Instead of constantly selling assets to pay for their lifestyle, wealthy individuals can sometimes use their growing assets as a source of financial flexibility. Stocks, businesses, and real estate can increase in value over time. And when an asset is eventually sold, the tax treatment can be different from ordinary wage income. The U.S. tax system has specific rules for capital gains, and the exact tax depends on factors such as the asset, holding period, income, and individual circumstances. So the strategy isn't simply, don't pay taxes. It's more like, control when and how taxable income is recognized. Number 5. They borrow instead of selling. Here's one of the most interesting strategies. Imagine a billionaire owns $1 billion worth of investments. They need $20 million for a new mansion. Instead of selling $20 million of investments, they could potentially borrow money using assets as collateral. Why does that matter? Because a genuine loan isn't the same thing as selling an investment for a profit. Borrowing creates debt, not ordinary income. Of course, the billionaire still has to repay the loan, and borrowing comes with interest, risk, and strict financial requirements. But it can allow someone to access cash without immediately selling appreciated assets. And that's where the famous idea comes from. Buy, borrow, and hold. It's not free money. It's financial leverage. Number 4. They use real estate. Real estate can play a major role in sophisticated tax planning. For example, U.S. tax law allows certain business or investment properties to qualify for Section 1031 like-kind exchanges. Instead of simply selling an investment property and immediately recognizing the entire gain. A qualifying exchange can allow the gain to be deferred when the requirements are met. Imagine owning an apartment building that has increased dramatically in value. Rather than simply cashing out, an investor may exchange it for another qualifying investment property. The tax isn't necessarily erased. It's deferred under the rules. And wealthy investors often care enormously about the difference between paying a tax today and potentially paying it years later. Number 3. They give away appreciated assets. This one sounds strange. How can giving something away help with taxes? Under U.S. tax rules, qualifying charitable contributions can provide tax deductions, and certain appreciated property can receive special treatment when donated to qualifying charities. Imagine someone owns stock that has increased dramatically in value. Selling it could create a taxable capital gain. But donating qualifying appreciated property to charity can potentially provide a deduction while avoiding the same capital gains realization that would occur from a normal sale, subject to the applicable rules and limitations. So philanthropy isn't only about writing a check. For wealthy families, charitable giving can also be part of sophisticated financial and estate planning. Number 2. They plan when they sell. Here's something that separates sophisticated investors from ordinary investors. They think about taxes before making the transaction. If you sell an investment at a profit, you may create a taxable capital gain. But investors can also have losses. Under U.S. rules, capital losses can generally offset capital gains, subject to specific limitations and rules. That means the timing of selling investments can matter. A wealthy investor might work with tax professionals to decide. What should I sell? When should I sell it? What losses can offset gains? Should I sell this year or next year? They're not necessarily trying to eliminate taxes, they're trying to avoid making unnecessary taxable events. Number 1. They think about taxes before they make millions. And this is the biggest lesson. Billionaires usually don't wait until December to ask, how much tax do I owe? Tax planning can happen years before a transaction, before selling a company, before buying real estate, before donating assets, before transferring wealth, before exercising certain financial rights, before making major investments. The wealthy often have accountants, attorneys, investment professionals, and estate planning specialists working together. That's why their financial decisions can look completely different from those of someone who simply receives a paycheck. They don't necessarily have a secret tax system. They have more sophisticated financial structures and professional advice. So, do billionaires simply avoid paying taxes? Not exactly. The reality is much more interesting. They often structure their wealth around assets instead of salaries, timing instead of immediate sales, borrowing instead of liquidating, and long-term planning instead of last-minute decisions. And remember, tax avoidance and tax evasion are not the same thing. Legal tax planning uses the rules that exist. Tax evasion means illegally hiding income or misrepresenting information, and that's a completely different story. The real lesson isn't that billionaires have a magic way to pay zero taxes. It's that understanding how money is taxed can be just as important as understanding how money is made. And once you understand that, the financial world starts to look very different. Subscribe for more videos about wealth, luxury, money, and how the richest people in the world manage their finances.